All right, it's time for another exciting episode of Random Thoughts McRae's Mind, the worst video channel on YouTube. And today, I'm going to be talking about why target date funds are a scam. Now, this video was prompted by a video by the lovely and talented Kyla Scanlon, who is a YouTube blogger who does really terrific videos, and I enjoy watching her videos. And Kyla is a very, very smart girl, a finance major with a 4.0 GPA apparently. And Kyla, it turns out, is invested in a target date fund in her 401k, and I thought, why is this smart girl in this terrible mutual fund? And that prompted me to make this video about target date funds, which I wouldn't have thought of really probably if I hadn't watched that video. I was just looking at some of her past videos because I was impressed by her intellect in her videos. So, Kyla out of college got a job with Capital Research, which is a gigantic mutual fund company that manages billions and billions and billions of dollars worth of assets and has quite a few very popular mutual funds. And they have a very, very long history of relative success. And so, now the thing about being a finance major, as Kyla was, is that you don't actually learn a lot about finance in college. You learn a lot about financial theory and you do a lot of equations and do a lot of math, but you don't really learn how investing really works. So, you don't actually, not that knowledgeable about investing. And Kyla is a person who's more interested in the macroeconomics. She's like interested in economic theory and all that sort of stuff. She's not really that interested in picking stocks and picking mutual funds and that sort of thing. She's really more of a big thinker. So, you know, she's the type that's going to get into one of these terrible target date funds, actually. So, what is a target date fund? How they work? So, in the late 1990s, people were piling into 401ks. You know, 401ks got really popular, and it turns out that 401ks are really, really poor investments for the average person. They do very, very poorly in a 401k, extremely poorly. You know, they'll make half of what the stock market makes because they're so bad at switching out of funds and not knowing how to invest their money. So this was a real problem for the 401k, and so the financial types wanted the 401k to be successful. So the academic types came up with this kind of cookie cutter portfolio strategy to be age based, that anybody could buy these funds based on a target date, and you know, you would be automatically allocated in a way that was appropriate for your age. And so Kyla was like 23 years old, you know, she got out of college, and she just picked the fund. It was age-based. She said, okay, I'll go in this fund. She didn't know anything about Capital Research's mutual funds or how well they performed. She wasn't interested in that kind of thing. She was busy, you know, working. And so she went into this target date fund. So the target date funds are good in theory. The problem is they're not good in application. So what are the problems with a target date fund? Well, number one is that you're going to be invested in managed funds, right? So I used to work for a major mutual fund company also, and we were actually one of the very first to offer these target date funds. And actually, when we were offering them early on, they were actually charging an extra expense for the actual management of the fund. They got called out by money magazines, some different places, and so they dropped that really fast because they got caught with their hand in a kitchen cookie jar trying to rip off people. But anyway, so this fund company operated their target date funds in the same way that everybody does. What they do is they put you into a portfolio of mutual funds that they offer, and it's really sexy. You know, they've got you in 4 different growth funds, 2 different value funds. They got you in international funds, and you look at this portfolio and you say, "Oh wow, man, this company is really managing my money." You know, and in reality, they're not really managing your money at all. They're just junking your portfolio up with a lot of crappy funds that have high expense ratios, and that's the problem with target date funds. Now, target date fund would not be a bad idea, really, if you were getting an index kind of Vanguard approach. Vanguard has some pretty good target date funds, and they go into indexes, so those actually would work somewhat well, as compared to Capital Research, which charges closer to 1% on their portfolios, although they have pretty low expense ratios for their funds. But here's the problem with any mutual fund that you buy is that over 30 years, 95% of mutual funds are going to underperform the market. Okay? So these fund companies are going to pile you into all these different fund companies because it looks really good. You know, I'm in this fund, I'm in that fund. They're managing my funds just the way they ought to be managed, and they're, you know, I'm getting all kind of risk diversification and all these different types of funds. I've got all this smart management going on for me, and in reality, you're just going to underperform the index because people are not good at managing money. You know, they don't do better than the market. They do less well than the market. And you just wind up paying an expense ratio for a portfolio of thousands and thousands of stocks. I mean, you're basically going to own who knows how many thousands of stocks once you're in like 12 different mutual funds in one of these target date funds. And so that's the ultimate problem with a target date fund, is that you're going to pay a huge amount of expense for your funds, and you're going to be over diversified. So if you want to have a good 401k, basically you just want to pick one fund, and preferably that would be an index fund. But what you want to do, find the stock portfolio that has the lowest expense ratio, and that's pretty much going to give you the best return over time. And that's what you're not getting in a target date fund. Now, the next problem, and this is the big problem with target date funds, is that they automatically put you into bonds. Now, going into bonds is not really such a bad idea. I mean, I mostly invest in bonds and mostly have invested in bonds. So that's not that bad of an idea, but they're going to put you in bond mutual funds, and bond mutual funds are really horrendous. They have high expense ratios, and you're ultimately making a bet on interest rates. So if you pick, you know, you're going into a bond mutual fund at the wrong time, and interest rates go against you, you're not going to make very much money at all. So bond mutual funds just are terrible investments in general. And especially now, I mean, Kyla Scanlon is 23 years old. She's got 20% of her money in a bond mutual fund. It's, you know, has a 2% return over 30 years at most, and she's going to be paying expenses on top of that, you know, on 20% of her portfolio. That's just a bad idea. You know, if you are going to grow your assets, you know, positively or negatively, you pretty much have to go with the stock fund, you know, a stock mutual fund. And you're just going to have to go with it. You're going to go in 100% because it's most definitely going to outperform the bond over 20-30 years. I mean, it's just ridiculous to even think about putting your money into bonds in any amount when you're going for long-term growth. And if stocks don't outperform that bond fund, man, you've got big problems. You're not going to make any return, so you might as well not even be putting your money in a 401k. So, uh, you know, you're going to be in these terrible bond funds with a big portion of your 401k, and then you're going to be paying these high expenses in all these mutual funds they got you into. So it looks sexy, but in reality, they're really, really bad investment strategies. They're good in theory, but they're not good in reality. And that's the problem with basic finance, is that it all works in theory, none of it works in reality. And that's true of a target date fund. But like I said, you'll probably do better in a target date fund than you would investing your own money, because people do really poorly investing their own money. But if you do want to have a decent return on your 401k investments, basically what you want to do is you want to put all of your money into a stock mutual fund, preferably the one with the lowest expenses, hopefully an index fund if you have that in your 401k. I mean, most 401ks I think now have index funds. They don't like to have index funds in 401ks because they're not money makers, but it's pretty well established now that people need index funds, so a lot of them are offering. They may be a lousy index fund, may charge too much, but hopefully you have that. And if you don't, then you want to put your money into the lowest cost stock market mutual fund that you can find, and that's the most likely to give you a decent return. But you want to stay out of bonds. You want to stay out of bond mutual funds, which are what these target date funds are going to have a certain allocation. And you know, as you get older and you get to the point where you're near retirement, I mean, it may be a good idea to go into bonds at that point, because you're going to be really taking a lot of risk, and a 50% reduction in the stock market is going to really put a whammy on you. So, you know, at that point, maybe having your money in a target date fund makes some sense, even though you're probably not going to do that well in the bonds. Would probably be better just to put, you know, a portion of your money into money markets or something like that. But it's a very difficult time to be an investor nowadays, and it's only going to get harder in the future because we're not going to have very high investment returns, and the 401k has largely been a failure, and in the next 20 years it's going to be exposed as a gigantic failure, and we're probably going to have to bail out the 401k like we have to bail out everything else related to Wall Street. But that is a future problem that society will have to deal with in whatever way it chooses to, if it chooses to at all, which it probably won't. But anyway, that's the summary today for target date mutual funds, why they are terrible, terrible investments. You're going to get put into a lot of mutual funds that are going to charge you a high rate of expense. You're going to have a particularly good return. It's certainly not as good as you would have if you just put your money into an index fund. An index fund will outperform a bond portfolio portion, you know, whatever portion of their portfolio, the index fund's going to outperform that. And I forgot to mention this, is that the government is supporting the stock market now, which in past years it didn't. So the government's always going to come in and rescue the stock market in the future and in the present. So you really do not take as much risk in stocks now as you did in the past, because the Federal Reserve will always come in and get that stock market back up, because that's going to be key to economic growth now and key in the future, and they're always going to come in and rescue the market. That will always happen. So taking less risk in a stock market mutual fund than you used to take, because the stock market is now government sponsored. It is officially government sponsored by Congress, the Federal Reserve, the President of the United States. Everybody's supporting the stock market. The financiers own the world. They're going to have the stock market bailed out. And so you're not taking as much risk as you did in the past, because we have a very managed economy, and that economy is being managed according to valuations of the stock market. So that's yet another reason that target date funds are poor investments, because of the terrible bond allocation you're going to have in your target date fund. Anyway, that's this video. Check out Kyla Scanlon's videos if you haven't. She is a lovely young girl with a great head on her shoulders, and I always enjoy watching her videos. And that is all for this episode of Random Thoughts from Crazy Mind, the worst video channel on YouTube. So long, YouTube.